Hello, folks. Good morning. Welcome to a new episode of GSN Invest. We are recording today from the beautiful city of Alibag, but we had an important macro event that came out yesterday, and I thought it's important to cover the implications of that, both for you and me as consumers, but also for us as investors as well, right? So, which sectors could potentially do better in the light of the information that we now have, and which sectors could potentially see some stress as well, right? So, uh, for those of you who haven't followed the news, the CPI number came in at 2.1% for June of 25, which is the lowest we've seen in the last 6 years as such, right? So, quite a surprise on that front. And it's been a consistent decline for the last 9 odd months, right? So, for context, the CPI number in October of 2024 was at 6.2%, which is just above the RBI comfort band. And since then, for 9 consecutive months, we've seen a decline to the 2.1% it is today, right? So, for context, the RBI has a target range of between say 2 to 6% with a mid band of 4, uh, and we now seem to be at the lower end of that band, right? Which is good for you and me as consumers. But when you're thinking about the broader economy, when you're thinking about the implications of that for the broader economy, might not be that positive as such, right? So moving towards the extreme lower band of the RBI range as such, right, which is slightly worrying at least, right? More importantly, these numbers seemed consistent across both rural and urban markets. The rural inflation came in at 1.7%. Urban inflation was at 2.5%, right? So broadly closer to the 2% range, right? So once this news is clear, let's try to understand what kind of drove the decline, right? So, and one of the primary drivers for that was food and vegetable inflation, right? So food inflation reported a decline. Vegetable and pulses were the two main categories that kind of drove the decline, right? Vegetable inflation was down 19%. Pulses inflation was down 11% or so, right? So food, which is a core part of the CPI basket, had a very sharp kind of decline in some of the key categories as such, right? That being said, other parts of inflation, right? So healthcare inflation, housing inflation, etc., remain fairly steady. So housing remains fairly steady at around 3% odd or so. Healthcare again in the 4% odd range, right? Which has been for a relatively long time, for the last 12 odd months. And core inflation, ex fuel, ex housing, continues to remain above 4, right? So uh, consumption in other parts of the market at least seem positive, but on the food side we're seeing a relatively sharp decline, right? So how do you think about this when you're thinking about what potential policy actions could follow, both from the regulator, which is the regulator in the central bank, which is RBI, and from the government, right? So, two major supports that typically come in. One, you have fiscal support. Second, you have monetary support, right? Uh, so important to understand before we can see what these guys could do in the future. Important to see what they've kind of done in the past as such, right? And the RBI, for its in its part, has been very accommodative, right? It's been kind of cutting rates, reducing CRR, infusing more liquidity in the markets via open market operations, etc. So a lot of measures have already been put in by the RBI to kind of move and kind of reduce rates, right? And it's important for us to understand that in an environment where developed markets rates uh, haven't been falling as sharply, and some stressors still exist in that sort of a market, there is only an extent up to which you can kind of keep cutting rates, right? It's not possible that we as a developing market and an emerging economy kind of cut rates too sharply, even as kind of global markets don't cut that, right? So while the RBI has been very accommodative, there will be a limit to which the RBI can kind of cut forward as well, which is why, at least in my opinion, it doesn't look very likely that the RBI will rush to cut, right? Given the data that we've seen, the RBI will likely wait a bit, at least for the next few months, and sometime in say October or so, reconsider their decision as such, right? What the regulator is likely to do is push for a transmission of rate cuts, right? So the regulator, to its credit, has kind of cut rates, but these rates might not kind of benefit the end customer directly, because banks always kind of cut with a lag, right? They'll cut with a quarter or two, and as a result, the transmission of this to the end customer ends up being a bit slower, right? So uh, that is one area where the RBI can kind of prod banks to try to trim or cut a bit faster as such, right? The government, to its credit, has also been relatively supportive. In the latest budget that came in, we saw the tax slabs kind of increase, and broadly there have been good support to the middle class as well, right? So uh, incrementally, we think the pressure on the government now will be a bit on the higher side, and we'll kind of cover that when we look at sectors that could potentially do well, right? And we also need to kind of look at other data points when we're thinking about this, right? So the gross tax collection data had come out some time back, and while gross tax collection did grow at around 3% or so, net tax collections fell quite sharply, and even the gross tax collections weren't the growth in gross tax collections weren't too impressive, right? So low single digit sort of growth there as well, right? So clearly looks that there are signs of stress in the economy, and what typically happens in an environment like this is if people are kind of pulling back on consumption, right? So two major levers of the economy go down. One is because India is a largely consumer centric economy. If consumption takes a hit in any way, you will have a relative contraction in the rate of which your GDP can potentially grow. And secondly, as domestic consumers show signs of consuming a bit less, the confidence of private companies to go out there and kind of put in additional capex, put in additional investments, goes down a bit as well, right? So, two major levers there will kind of get pulled back, and the government will potentially have to do some amount of heavy lifting to compensate for that, right? So, given this context, right, given the inflation environment, the actions that the RBI and the government have already taken, and the data that we're seeing from other sources, broadly looks like we are in a relatively weaker part of the economic cycle as such, right? So, as investors, how do you deal with this? Which sectors do you kind of stay away from? Which sectors do you potentially be a bit bullish on, right? So, one sector that you would want to stay away from a bit is retail unsecured lending, right? So, this sector has been seeing pain for the last 12 odd months, especially in the microfinance segment, which is the lower end of the basket. Multiple reasons for that. So, we'll cover microfinance in detail in a later video. But broadly, retail unsecured has been seeing some amount of stress, and in all opinion, in all likelihood, that will kind of continue, right? So that was showing some signs of kind of reversal, but that will likely continue for some time, because what typically happens is that in an environment where there is relatively subdued demand, it's possibly a sign that the lower classes will kind of get a relative hit, and in an environment where you are running a deflationary environment, right, it's likely that kind of wages, incomes, etc., are not rising as fast, and that makes debt burden even more of a problem, right? So, uh, microfinance was kind of facing the stress. We think retail unsecured will be a place that you ideally should stay a bit away from, because that space could continue to see some stress in the near future as such, right? One space that we think could see a lot of positives and could see an upsurge is any area linked to government-backed spending as such, right? So as we've seen, the consumption part of the lever could seem to be coming down. As that comes down, potentially private investments would at least reduce a bit as such, and to kind of compensate for that, the government might have to do a bit of heavy lifting as such, right? So any area where the government spends, right, building roads, in railways, all of this, this is typically a good way to infuse money into the economy as well, right? As you're doing infra, as you are building out more roads, highways, etc., that typically puts money into the hands of the bottom of the pyramid who are engaged in these sorts of activities, and it gives some fillip to the GDP as well, right? So that is one area. Government spending is, and sectors linked to government spending are one area where we feel there will be focus in the times to come, and where broadly you should see broader growth, right? So that was the news item. We'll see you tomorrow, and hope this video added value. If it did add value, please do share it in your network. We are a relatively small channel right now, but with your support, please do subscribe and please do share it with your friends as well, so that we can keep growing this and keep coming out with good content for you guys, right? Thank you so much. Thank you for your time.